Hello, everyone. I'd like to welcome you to today's webinar, 5 Things Your Boss Wishes You Knew About Finance and Business, brought to you by the Wisconsin School of Business Center for Professional and Executive Development, or CPED for short. CPED offers online and in-person programs and certificates that will give you the modern, relevant skills needed to advance your career. All of our programs offer interactive live learning sessions facilitated by instructors with practical business experience. CPED also partners with organizations to provide customized professional development programs, coaching, and consulting. For more information on the Center for Professional and Executive Development, please visit our website at uwcped.org. For today's session, you can ask questions throughout. We will save the last 5 minutes of today's session for questions, and you can put your questions into the Q&A box located at the bottom of your menu. In addition, if you want closed captions, we have turned those on as well, and you can put those on. And now I'd like to introduce to today's facilitator, Dan Topf. He's the Senior Vice President at Management Development International, Inc., and an instructor for the Center for Professional and Executive Development. Dan has focused his professional career on helping leaders use their new skills to impact real business results. He specializes in bringing experienced leaders the business acumen they need to make a real difference. Dan, thanks for joining us today. I'll pass it over to you.
Thanks, Jeremiah, and welcome, everybody. I am delighted to be a part of this webinar for today, and thanks for making time for us. Here's what I have in store for you. Where are we going here? Well, after a little bit of welcome, which is what we've just done, I want to introduce to you these 5 things that your boss wishes you knew more about, and explore it in a little bit more detail, or explore all 5 of them in a little bit more detail. The first is to talk a little bit about margin and a none, give you a little bit of a story there. Asset speed and the bringing of friends. We'll also explore cash and your mother. And then we're going to grow on purpose. And of course, our most important asset, people. And then we'll adjourn today. There has to be some reason for learning all of this. And for many people, in my experience, there are several great reasons why we need to learn more about the business. Generally speaking, it is a catalyst for your career. It sometimes keeps people from moving and achieving their career ambition because indeed they don't have the bigger picture. So we must know how things are scored if we are to win. What I mean by that, I mean, if we're playing a game, it's important to know how we're keeping score. And for many of us, that's a little bit fuzzy. And so we need to learn more about how we do that. In order to win, we must also learn the rules of the game. So how do the rules of the game affect the score? And then there is a certain fluency in reading scorecards, not of our business, but of all of the business perhaps that we interact with. And then finally, we must be skillful in putting that knowledge to work, and we put that knowledge to work through our decision making. And then finally, if we don't have the game plan, then scoring also becomes a guess. In other words, we're hoping for better outcomes. You'll explore things and you will expect things to happen magically or maybe even mysteriously. So in order to be more intentional about our roles, that's the why of learning about the game of business. So what are we really building here? We're building what I refer to and what many of us refer to as business acumen. Business acumen, as defined by Kevin Cope in his book, Seeing the Bigger Picture, we understand how you make money and acting to improve the money-making process. So we understand the bigger picture. We see different terminology and financial metrics. We see ratios and dashboards, and we understand them. Okay, good enough. No, not good enough. We must now act, take initiative to raise issues, to include information, to include this understanding to affect the outcomes of your various decisions. It's been my experience that we have maybe a rudimentary broad-based understanding of, well, this costs more, therefore it's maybe something we need to think about, or these two options, this one costs less, maybe that's the one we should choose, but maybe not. Okay, we have these kinds of rudimentary understandings, but when we have true business acumen, we understand the wherewithal, the goals, the objectives, maybe even the aim of our business as to what type of business it's trying to become. And then we're making thoughtful near-term, medium-term, and long-term decisions to improve that process. So all of this, by way of introduction, is to give you the 5 factors, the 5 things that we have discovered in my work that your boss wishes you knew, wishes you understood a lot better. What are they? Let me talk to you about them each in turn. The first, margin. Margin is however many pennies of each dollar of sales you keep as profit. And we'll express that usually as a percentage. So let's say you have $1 and our gross margin is 50 cents. Our operating margin might be 10 cents and our net margin might be 5 cents. Each of those margins could be represented as a percentage, of 50%, 10%, and 5%. Margin is your profitability. Margin is matched to the various periods that we work in business. So we want to match the period with the revenue and the costs in that period. And are we making money that period? Okay, so margin is the difference between sales and profits. Next, we'll talk about speed of our assets. That's the next factor. The next thing that I think your boss, your CEO, your executive leadership wishes we understood better. What are we talking about here? First, let's break it down. Asset, that's maybe physical assets like inventories, buildings, delivery vehicles, space in the ER. We are wanting those assets, those things that we have that we use in the business. That also includes people, capability, their passion. And the speed that we are bringing in is speed to what? Not so much that we're running around quickly. No, speed to payment. I'm going to talk more about that in a moment. What do I mean by that? I mean speed to bring to bear that we can earn revenue for it and earned margin. So we have assets brought to quickly to revenue. So if we're going to purchase a new delivery vehicle, how quickly can we get it into service? If we are going to add ER space to our hospital, how quickly can we get that up and running? We've got a product development process and we're going to add manufacturing capability. How soon will that be up? Let's get it moving. We're going to buy raw materials so that we can make new products. Fantastic. How soon will we use that raw material? It's about the asset, understanding which assets are which and what value they bring, and then how fast we bring them to revenues and profits. So those two, margin and asset speed, work together to show and to drive performance in a business. And then, of course, the third next business factor, that of cash. Cash and cash flow. We want more cash flowing in than flowing out. It is also a measure of speed. So when we spend $1, when does it come back? Right? How soon, how long do we need to wait for the money to return to us? So if we spend $1 in, let's say, salaries, if we spend $1 in cell phone expense, if we spend $1 in marketing, when do we earn that dollar back? And is there any margin on that? And is there any more coming. So in other words, when we spend a dollar, when does it come back, and does it bring any friends with it? All right, number 4 in our 5 business factors is that of growth. All businesses need to grow. If businesses are not growing, they're dying. We're looking for top line growth, that is to say, sales and revenues. Sales and revenues are the same thing. There are growth drivers like volume and innovation, and we'll explore all of those as we explore each of these 5 factors in some depth. And then, of course, number 5. What is number 5? People. People is the 5th growth factor. We understand that probably innately, that all businesses are in fact a enterprise of people, but sometimes we have to define which people are we talking about, which stakeholders. Perhaps it's employees and their talents and initiative and inspiration that we bring to bear. But also it could be people that we interact with who are our customers or our stakeholders in our communities and our relationships with them and their ability to trust us and to build value for them over the long term. So each of these business factors are what we have discovered in our work in business acumen at the University of Wisconsin, that, if we understood these more broadly, we will have better opportunities for success, better opportunities for all of us to be working and pulling in the same direction. So let's go through each of them in some depth, shall we? The first I mentioned was margin. It's the first of our business factors. I'm reminded of one of my favorite business leaders, Sister Irene Krauss, known in the 60s and 70s when she was a hospital administrator for the Catholic hospitals, the Sisters of Charity. She known as the CEO nun, and she believed in strong fiscal management. And she had a phrase, a mantra, if you will: no margin, no mission. You know, if you think about the Sisters of Charity, they have such a strong mission of serving and of service. And yet they needed to be profitable in order to do it. And some people, particularly who went into the convent with her, seemed to have only a focus on mission and would potentially just not have that financial discipline that potentially was really enabled their ability to fulfill their mission. So as you think of that, think of many of you who have very strong missions. Maybe you work for a government agency. Maybe you work for a nonprofit of some sort, maybe a community organization. Maybe you work for different types of organizations that maybe have a very strong mission. And yet the ability to make money, in other words, to have some margin, is absolutely critical. There's this principle of sufficiency that we should consider as well. And when we're working in nonprofits, maybe cooperatives, maybe other types of organizations like this that have a strong social mission, we have to say, what is sufficient for us to meet our needs? And in cooperatives, once we have met sufficient amount of profitability, they pay out dividends to the owners, to the members of the cooperative, to share in their success. So nonetheless, it requires margin to achieve our mission, and that's why I like Sister Irene. So what is margin? It is a ratio of revenue or sales against profits. It's the percentage of profits related to sales. And we have different kinds of profits or subtotals of profits on a profit and loss statement, also known as the income statement, like gross, operating, and net. You might have another one called EBITDA, earnings before interest, taxes, depreciation, and amortization. And when I think of these, I think a good mnemonic is gross, operating, net, and EBITDA, G-O-N-E, money's gone. And we have gross margin percentage, operating margin percentage, and net margin percentage, each telling us something slightly different about how well our business is performing. When we use this notion or use this understanding of margin, well, we can answer several important questions. We can work and take actions on improving margins in our business. For example, can we focus in on the things that are most profitable? What percentage of our business is of that profitable service or of product? How much do we make on a unit? Should we be focused on volume or should we focus on cost? What do we sell the most of? And should I align with that? When we are growing, we should see some costs grow with it. That will be variable cost. Some costs are fixed. What volumes require fixed cost increases? What volumes drive costs up faster than sales? And what costs are these? Wait a minute, what are you talking about fixed and variable? Which costs go up and down with volume? Which costs seem to stay fixed? In the long run, all costs are variable, but accountants seem to treat certain costs as fixed, like overheads, like general and administrative expenses, like marketing expense and those types of costs. But other costs like raw materials, labor, direct expenses of some sort, those will go up and down with volume sold. And as a result, we'll treat those as variable. So it's important that for many of us to align with questions like these. Can they answers of these things help us when we are trying to align ourselves and take good actions with regard to margin. Next, asset speed, business factor number 2. I start this off with a think about. Is this a question that you're thinking about, or is it even the right question to ask? That is to say, what's the deal with inventory? Do you want more, less, or what? It's also helpful to do this in your best Jerry Seinfeld voice. But what is the deal? When I ask this in my seminars, sometimes people think, well, wait a minute, do you want more or less? You want the right amount. Okay, tell me about what the right is. Well, they'll answer that by saying, well, it's the right so we don't run out too soon, or that we got it at a good price, or well, now we're a little bit confused. I don't know if we want more or less or what. Well, it is in fact the incorrect question to even ask. You know what we want? We want our inventory to move. It's less important how much we have. It's more about how fast it's moving. So if we have a small amount and without stockouts, will we have a large amount without stockouts? Okay, that's important to keep in mind. But also, how long is it here? Is it here very long? We might be stocking up for seasonality. We might be stocking up because we're doing a initiative that will have marketing and new demand created. And so we need to be prepared to respond to the needs of our customers and be responsive. So as we are thinking about the success of asset speed and the success of applying that principle, keep this in mind. We want things to move in business, because remember, it's about when we spend that dollar, when do we get it back? It's about the cash conversion cycle. Keep this in mind. When any delay happens, we might hurt our margin. It begins and ends with cash. So let me give you a bit of a model of how we might spend that dollar and where might it go and where might it be before it comes back. And so that tends to go to suppliers and vendors to give us the raw materials we need to put into process, and then in finished goods. So we'll make the things that we sell our customers, and we have them in finished goods inventory ready for customers to buy. And as a result, customers buy them, take them from us, create an accounts receivable because they'll pay the bill after we send them the invoice, and then ultimately it turns back into cash. We will have other expenses that we might incur, like sales in general and administrative expenses, research and development, which would be investment into long-term opportunity, things that we do to develop the business that could have commercial value to us in the long term, and other operating expenses. So as you think about all of this money being put into the business, when will we get the dollars back? Because we want cash to flow in faster than it flows out. So you'll see companies doing different types of things, like maybe it's contract inventory, maybe it's payment terms or enforcing payment terms with customers, maybe asking customers to make a down payment so that you can use customer monies to buy the materials to build the inventory, to build the products as we go along and cycle this more efficiently. Some of you work in service businesses, so you want to think about this cash conversion cycle from the standpoint of people and consumables. You know, some of us are in healthcare, for example. And so we have suppliers and so on in healthcare or in professional services, but we don't carry the inventory. So if we have people in process, but we also have people available to serve customers that are underutilized, that's an opportunity for cash conversion improvement. The third of our 5 business factors is cash flow, cash flowing in faster than it flows out. You may have heard that cash is king, cash is freedom to act, cash is so important. Well, entrepreneur and business executive who was Al Shugart said, cash is more important than your mother. Now, I don't know if I necessarily agree with him, but he was talking about it from the standpoint of being able to get your new business, your small business off the ground and successful. And so paying for things before you get paid by customers is risky, and so you want to do it quickly. So it's related again to the asset speed. Al Shugart was very much tuned into the idea of, all right, small business, medium-sized business, or even large business, when you spend money, you need to know when you're going to get it back and when do additional dollars come with it. Does it bring any friends? Without the appropriate attention to cash flows, you won't be very successful. So there are really 3 types of cash flows. There are indeed operating cash flows, investing cash flows, and financing cash flows. Your boss wants you to understand and interpret these and integrate the cash flows into some of the key decisions you're taking. Cash flows from serving customers in many respects are the most valuable. This gives you as a business the most freedom to act. You might have investing cash flows, that is, cash flows for long-term investments, buying equipment and bringing it into service. Let's say you buy an excavator and you put that excavator to work and digging trenches. Well, that's what we do, and we can then get paid for it. So we buy and sell our assets we have for longer term, like equipment or buildings or property and so forth. And then, of course, we have financing activities. This is a cash flow in. And for many people who are not part of the finance department, this is a new thing to really come to realize, is that when we borrow money for the business, it's because we need it. We need it to grow. We're going to then perhaps invest in the business because we need to buy an excavator and we have to finance the excavator, but because we don't have enough money on hand to buy an excavator, and then we put it to work, and that generates operating cash flows. Another side of our business might have investors. We might have family members. We might have members to the organization. We may even have publicly traded stock, and that generates financing cash flows when we buy and sell our stock, creating cash so that we can invest it or pay for operating cash flows. Since operating cash flow is so vital to the success of our business, we want to have sales and gross margin to drive it. We want inventories to turn quickly. Again, it's about speed, days of sales outstanding. We want low numbers of these for our customers to pay their invoices quickly. We want days receivables outstanding. We want to manage our fixed and our variable cost. All of these factors drive our operating cash flow. Our fourth factor is that of growth. Growing the business should be something that is intentional. Edward Hess, wouldn't it be great looking at this guy? Wouldn't you want to have a class with him? I think that would be great. But you want it to be not an assumption, but a well thought out decision. So you have growth strategies that we employ in our businesses. What are we talking about? Growth strategies? Well, it's about, well, how are we going to sell more of our existing products and services? And how are we going to expand our existing markets? Do we have new products and services that we are launching? Or do we have new markets that we are growing into? And with the Ansoff matrix, we can begin to deploy what they call a growth strategy, where you might diversify, or you have a market development strategy, or a product development strategy, or a market penetration strategy. With our clients, we go into some depth on this, and finding the entire portfolio of products and services might fall into one or more of these, and then have and then equate to an action plan for the organization. By understanding how and where your business intends to grow, gives you focus, lets you allocate key resources, set up budgets and other kinds of resources, put assets where they're going to do the most good for the business. Next, people. People, oh my, what an important factor. One thing that I always think of when I'm thinking of people, as it relates to a business factor, is the poet Maya Angelou, who said, people will forget what you said, people will forget what you did, but they will never forget how you made them feel. And isn't that true these days with the great resignation, the great redirection, the great recalibration of talent across all of our organizations? They're anticipating how they're going to feel working for you. And we have found how it feels to work from home, to work in a great office, to have great work to do, to feel committed and engaged with other people, as well as having suppliers we can count on, business partners that we trust, customers that we're learning a great deal from. So it's important for all of us to have that perspective in business, that people have strategic value in the organization, and we need to have compelling and realistic and informed decisions or informed opinions about these kinds of questions, like, well, which skilled people are most valuable, and how do we find them and engage with them? How are our tools and processes being utilized? Do we use our tools and processes to create really sustainable and distinctive value for our customers that they're willing to pay for? And do we have customers who partner with us to not to force us to innovate, but encourage us to innovate and create new solution sets? Carl Eric Sfaby put this into a model of the value of the enterprise. And we say that we have not only just the tangible value of a business, but all of these intangibles as well. Our capability of know-how, the reputation for solving complex challenges. And when you look at the valuations of businesses, when small businesses get ready for sale, you look at future value, like their ability to make money into the future. And when you think about margin and asset speed and cash, that's about how you've done. It's backward looking. But when we look at the people and the growth factors of the business, those are forward looking. How are you going to create business and value and success into the future? So there you have it, all 5 business factors: margin, asset speed, cash, growth, and people. It's been my pleasure to share these 5 factors with you, and I encourage you to look into partnering with us here at the Center for learning more about how you can use these 5 factors in wherever you sit in the organization. Thanks so much.
Thank you so much, Dan. With that, we'll open it up for questions. You can submit your questions again using the chat box or the Q&A box at the bottom of your screen. Dan, I had a quick question from a few different individuals attending today that come from either large businesses or private companies
Mhm.
where they're not given a lot of information about their finances. Um, is there anything that they can do or anything that they can use in order to overcome the lack of information being shared with them?
Well, yes, there are. I would say the first thing is to ask. All right. So since they don't share, maybe you should ask. Also, go with confidence that you need this kind of information in order to do your job. You want me to do my job well? I need to know what the budgets are and what the priorities are in our budget. Where are the resources going, and so forth. In order for you to do well, you might ask about financial targets, maybe knowing what the aim is for the organization. What are we trying to create here? What sort of growth strategy do we have? I think some of that is shared pretty widely in most organizations. I have found too that many times individuals inside of organizations may not have taken the time to look at your own corporate websites and your own corporate press releases, and also the local press. For example, local newspapers all have business sections that will do profiles. You put a new office, you set up a new production facility in a town, and it'll get covered, and there'll be financial information presented publicly there. So there's a number of sources of this type of information, but always ask. There's kinds of information that is only shared internally. That's called cost accounting or management information, and I think that is that's your first step.
Thank you so much, Dan.
Sure.
We have a question from Deb regarding the 4 product growth strategies.
Mhm.
Is there a method for identifying what should be the priority?
Yes, you would go through an analysis of the marketplace, and that generally is a very well, it's very popular now to use business analytics. And so there's loads and loads of data. Let's say it's a consumer business, consumer-based buying habits, consumer testing. You might be doing online tests and so forth to see what type of thing that consumers are responding to. Also, you might find that you are doing analysis of the customer's needs. So for example, getting the people who serve the customer on a contract or on a delivery, or product development people and service people, communicating with the marketing and sales departments within organizations to understand, well, what do customer needs, what's going on, what is their pain point. They talk a lot about pain points. All of that leads to where's the opportunity? And then that's where managers use their judgment. We see opportunity in this space, and so that means we can sell more products to our existing customers because simply they can do better. So many banks do this. They sell you multiple products to the same customer, a loan, a credit card, etc. So then you savings account. They're trying to get more products per customer. But in other, like for example, automobile industry, they're going into new markets with the same automobile model. They might even have models that are discontinued in North America, but are still being made in other regions of the country. So it depends upon the analysis by management as to where the opportunities lie. If you're not a part of these conversations, it might be helpful just to look at the model and think, well, what is happening with this particular part of the business that I am attached to? And you might be able to see and realize, oh, we are in a diversification model. We're doing it all. That's why it's so challenging, for example.
That's wonderful. Thank you so much again, Dan. Before we end, I just wanted to let everyone know that these finance topics are further explored in CPED's Finance and Accounting for Non-Financial Professionals. In this program, Dan and Ann Martel will help you master the financial language of business and discover how to make decisions that lead to financial success for your department and for your organization. We'd love to see you in the next session, which starts October 3rd, going through October 5th. Again, thank you everyone for attending today. Be well.